Now we have our pivot into the US, and we want to always look at that, refined products and some of that demand. So you can see that the current demand had a nice increase from 14.32 million barrels a day to 14.8. So we got that nice jump. But the one thing that we always try to, put into context is we normally get a jump this time, and then it usually continues for a bit. And that's the biggest and most important thing in terms of we got that increase, but where's the fade? Are we going to get a fade? And the gasoline number, again, just doesn't really jive with what we've seen from both Gas Buddy and TomTom when you look at some of these flows. So again, it's a point in time. And the point in time that the EIA is looking at is which is why they talk about supplied, because they're calculating demand based on what's being supplied to the market. So they're looking from the tank, once it leaves the tank, going to the blender, and then from the blender out to the retail world. But the retail world may have delayed purchases because of weather, or they might have had an excessive pull down because of weather, because of vacations. Because just think theoretically, when you're going to travel on July 4th, you don't go get gas July 3rd. You're going to get it, a few days ahead because you're probably driving on the July 1st, July 2nd. It's obviously going to matter, where does it fall? Is it on a weekend? Is it during a weekday? And that's why some of these spikes, seasonally speaking, can just shift. They can be a little bit earlier, a little bit later. So this one came essentially right on time in terms of where we start to get this pivot higher. But one of the things, we normally get a pivot and then it pulls back, and then we start to get that kind of that continuous move up because it is spring, March 1st, as we get into spring and it gets a bit warmer, people go out driving, they go to parks, they do things, but there is a setback in the sense of when you look at what is happening with going to the office, we're still 40% below normal. We have Brookline just announcing a bankruptcy with several others coming along the way. And there's a huge, Brookfield. So PIMCO, Brookfield, office default, signal deepening property pain. There's a lot of stuff coming due this year. That's going to create this cycle that is going to be really important to watch and look at when you start to see some of these underlying pivots. So again, these are some key things to watch. This is obviously a good number. It's just realistically, we think we come back down to that 14.4, 14.5. And as we've been saying, it's going to get better. That is a foregone conclusion. Any month outside, any year outside of 2020, you can see that there's a fairly steady increase. And that is, again, going to remain the case as we go forward. So it's just going to be at a reduced rate versus normal. So Distillate had a small build of 180,000 barrels a day. That's 15.2 million below the 5-year average, but 3 million over the year over year. So again, we're continuing to shake off some of this move because when you look at any year, whether it's above the average, below the average, we should be drawing, and we're not. Instead, we've had multiple periods of builds over the last couple of weeks, realistically over the last month. And that's just because we've had a decent amount of imports. We've had a lot of slowing demand because it's been very warm. You've had a lot of on the trucking side. Trucking has slowed considerably. So, and this is still the best margin, even though you've had some of those demand hurdles. This is where you're getting the best margin. So not only have you seen demand pull back, but refiners are going to target this specific creation. So then when you look at imports were down 217,000 barrels a day. It was all driven by Pad 1, which is down 243,000 barrels a day. Still against the 5-year average, still just 87,000 barrels a day below average. So we're still getting some of those excessive imports. The question's going to become, do we continue to export? And that's going to be the question because Russia's taking a lot of our market share in Latin America. It's taking some of European market share from Africa, and that's where you're getting some of these shifts in terms of flows. So Europe's still going to buy from the U.S., but if they're not sending as much out, are they going to need as much? And then if we can't send it to Europe, where else can we send it? And that's where we could see, especially on the distillate side, we could see some sizable builds over the next, not so much in the next few weeks, but as we get really towards the warmer weather, that's when you could start to see those builds accelerate, just because trucking is already slow and you're going to have, again, that weather ending. So when you look at crack spreads, it's still at the low end when you go back through 2022, but it's still elevated over the last couple of years. And that's something we don't see changing in the near term. We do see some pressure to the downside, but a lot of that is going to be driven based on how are exports performing. And as exports decrease and builds continue a counter-seasonal trend, we do see that pulling back closer to a $30 spread. And then the question is, where's gasoline? If gasoline is still weak, that's going to be a very difficult number for some of these guys to make enough money to rationalize coming back to the same level that they might have been considering. Pad 1 builds, here you can see it's flatlining. A lot of this it's still on the low end. You're going to get a little bit of a reprieve just because we do have a small cold front coming through, but again, still coming towards the end. And then when you look at Pad 3 is still kind of balancing around, but as more Russian product comes into the market, that's where we start to get concerned about, well, how much of it is going to get stuck in storage, because we don't see refiners pivoting too much right now. And until we start to see this come, let's say, even just, it doesn't have to go and surge back up, but just get a back above and set new 2023 highs. And here's how we continue to bump along the bottom. As we were saying, we expect to be right on the low end of the cloud. We don't see that changing from a distillate demand center perspective. It's still going to be very low. It's not going to collapse. It's just going to be very much on the low end. And a lot of this is just with the softness in trucking. We're just not seeing any new need. And if you go back through 2021, 2022, even as gasoline demand stayed low, this surged and you had a massive buildup and you had this huge demand cycle. Now as gasoline normalizes a bit, you're just losing a lot of the diesel bump. So again, and not that gasoline is going back to normal, it's just gasoline isn't as depressed as it was in 2021. 2022 it was pretty good, but 21, 20, and that's where we see this pressure point and why we talk about being below what is historically normal, just because of those some of those areas with more pressure on the rail traffic side. Total car loads at 0.1. Chemicals fairly stable. We see that again with the headwind. Coal moving around the way it should. Grain, forest products still going to be there. Petroleum products still trying to move around, trying to move this product. But intermodal is where we continue to see the pressure points. Intermodal's down 11.1% year on year. Based on trucking, based on imports coming from the ocean, we just don't see intermodal going well. And that's going to be a big overhang, because not only is it going to impact the diesel demand going into rail, but also when this shows up at, factories and warehouses, and it just is showing you that the ISM manufacturing, how it's still in contraction. That's the intermodal side. Inventory still elevated. All of those things are just showing to an inherent economic slowdown, which again is going to put a lot of that cap into the diesel market. When you look at volumes coming in, as we've been saying, year on year, things are low. I mean, when you look at coming in the beginning of March, we're anywhere between 25% to 47% below last year. And it's just, we don't see that changing based on vessels within 40 nautical miles. The average waiting time, total vessels due, there's just not a whole lot of flow, which is why when you look at some of these activity ratios coming out of China, you're like, but where is it going? Because is there such a shortage within the country that it's just staying in the country, or is it something where some of the numbers may be overstated and but not to say that they're in contraction, because they're not. They're definitely growing, but to what degree? Like Saudi Arabia right now, or sorry, I should say Saudi Aramco, said they see very strong oil demand from China. Which again, we're not saying that oil demand goes down in China. We're just saying that as oil demand goes up there, it's going to decline in other places, and you're going to see more of that balancing act. So then when we look at weather, in terms of where things are, there's a little bit of cold coming into the New England tri-state area. That's going to give a nice little bump for, a little bit of a bump to heating oil, nothing meaningful. And then things should start to warm up. Obviously, there's a lot of cold that persists in the southwest as well as the northwest. That's something where when we get the snow melt coming out of California and some of these highlands, it's going to be an interesting time to see how quickly and if we get any mudslides. So that's going to be an important one to watch when we start looking at some of the infrastructure as some of those heat waves continue along those La Nina lines when you look at the south. Now switching gears to gasoline. Gasoline had a draw of 870,000 barrels. It's still 14.1 million below the 5-year, 6.8 below the year over year. But it's important to recognize that one of the things that we've been talking about is that we expected a flat line, and we expect that flat line to persist. But if you look, there's normally this crescendo where you have this peak, and then gasoline storage comes down quite hard, and you get kind of this normalizing effect around the end of March. One of the things that we've been saying is that the comps get easier because as storage goes flat, it's going to get closer and closer and then likely above the 5-year average, which is why, the 5-year average is a way to measure things. It's not end all and be all, but it gives you an idea of kind of where we are versus historics. And we just have this balancing approach, which is why we don't think gasoline is in a great spot. And it does get very normal very quickly. The draw was driven by pad 1 as well as pad 5. But things are still fairly stable. And then pad 2, pad 3 still have some of those fairly lower levels. And that's something, especially pad 3, could adjust quickly because we do see mounting pressure on gasoline exports as we do have more imports. Imports started again into the U.S., an increase of 197,000 barrels a day. That's, all of it was driven by pad 1. And then we had the 5-year averages imports were over 182,000 barrels a day above the 5-year. And that's, we do have some additional flows based on what's coming down from Europe. Very, very normal, just because we have a significant amount of product sitting in Europe that has to flow down, has to find a home. And as you get a little bit of a normalization in day rates based on what's going between the U.S. and Europe, that's going to open up the ARB a bit more. When you look at blending components, again, flatlining. One of the things that we saw in general, there was a draw of 850,000 barrels in blending components, very much in line with where gasoline is. So when you look at petchem demand remains weak. Sabic said something very similar. And that's when a lot of this is going to just stay in the market, stay in the gasoline pool. And you could see that as we flatline, there's normally the sizable drop. We just don't see that drop. And that's where we're going to get very normal very quickly when you look at gasoline versus other. Now looking at Gas Buddy, here you can see that they had averaged 8.4 million barrels in terms of demand. And that's, again, some of the conundrum that we're sitting in, because we see 8.4 to 8.5. We're very much in line with this, but yet you're getting this gigantic surge from the EIA market. And again, it's just timing. It's just, is there something that has to be cleared? We've gotten a lot of questions on the adjustment number. The problem is there's timing delays with a lot of this stuff, especially when you look at exports, imports. And at times it takes, you get that adjustment factor just because you have to get the paperwork filed to clear. And usually that's how that will get cleared up. Some additional supporting pieces. When you look at North America, we continue to see a bit of that decline when you're looking at just underlying activity continuing to move a bit lower. Asia Pacific, something similar. Europe starting to come down, flatlining a bit, but you can see they're all moving in the wrong direction. China's come down, but still very strong versus historics. This continues to diminish against the 2019 levels. Now, when you look at pricing, diesel prices continue to fall as well as gasoline. Gasoline's going to be an interesting one, though, because we're pivoting from winter grade to summer grade in terms of some of the pricing, because as we convert to the April contract on the gasoline side, that is summer grade. And so it's going to be important to look at where are we, and that'll stop some of the declines. It's not going to put a huge bid into the market, but you're going to see some of those declines falter for a moment. But we do see, again, additional builds in storage, some of that normalizing against the 5-year, it's normalizing on that level, and that will start bringing some of that gasoline number back down. Here you can see the increase in underlying demand. You can see that nice little surge. You can see it happened a bit earlier than what is normal. And again, it's just that timing piece. But when you look at it in general, we do expect this to fall back. Does it fall right back to 8.4? Probably not. It could either only come down to 8.8 and then another, or there could be a sizable correction from 9.1 to 8.2, and you have to average the two together. And again, these are some of the pieces, which is why week to week, the numbers can be lumpy, which is a reason we talk about the 4-week rolling average, because a lot of these things will get averaged out over time, which is the importance of it, but we like to look at trends. So the trend is up, but typically we should be trending up. We're going into winter, into spring. We're starting to get some of that people moving around. We had February break, people moved about. Those are things that will be some of the positive tailwinds. Propane, propylene, draw of 2.96 million, still 14.7 over the 5-year, 25 million over the year-over-year. So rate of change stable, just at a much higher level, and just based on what we're seeing from petchem, we just don't see that changing, as well as when you look at just underlying heating demand, not there, and so things are going to be fairly sticky at those levels. Jet had a build of 260,000 barrels, right in line with last year. When you look at demand, again, right within our wheelhouse, we said 1.45, 1.55. It's at 1.513. Again, not much to say one way or the other. When you look at TSA passengers in general, coming down a touch. When you look at Eurocontrol, flatlining. Again, as TSA passengers remain here, it's just going to be, I think, weekly decline of negative 0.7 to 101.2 to against 2019 levels. But as passengers remain stable, flights are still staying offline. And that's where we continue to see, as we show here, some of that stability against 2019 and 2020 levels. And then obviously 2020 drops off when a lot of that flying was shut down. Open table, when we look at people going out to eat, you can see that there's, we're about minus 1%. Again, just fairly stable. The January numbers were shocking in terms of retail sales. So far, February is still showing things are pretty good. And I know I had sticker shock when I went out to eat. So as long as people can manage it, I was having a conversation with a friend of mine, and he was saying, if you do all the prep work, buying the food, cooking the food, how much it's still expensive at home. And, does it make sense to go out? Again, it's still cheaper to eat at home, but again, these are some of the bigger shifts that we're seeing. And you can see that there's still some of those pivots to the downside. This is going to be an important one to watch to see how the consumer fares as we go into harder comps, because typically March, April, people eat out more. You can eat outside, especially as you get into April and May, and that's going to be a fun one to balance. So that's what we have for you in the U.S. The next segment, we're going to go deeper into Russian flows, global flows, and where some of those global refined product storage levels sit.